As we reported, investors cheered today's jobs report, but what should they do with their money in today's market? Our Market Monitor guest has some ideas. He's Mark Yusko, Chief Investment Officer and CEO at Morgan Creek Capital Management. He manages about $4 billion. Mark, welcome. Good to have you with us. We could spend a lot of time talking about whether you think the Fed's going to raise rates in June or July or September or never, but I'm bored with that. I'm bored with that. Yep. I want to get right to your stock picks. Your first one is an airline. Why?
Yeah, well, I think the common misperception is that the airline business is a bad business. And, for 30 years, that was true. It was a terrible business. They lost money as an industry for 30 years, up until about 3 years ago when consolidation put a lot of pricing power back in the hands of the airlines. So we think it's a fantastic business. We think American in particular is very undervalued and has a lot of upside. And I think people really don't appreciate how much fuel savings they have with these lower oil prices. So we think there's significant upside in the airlines broadly and American in particular.
And you also like Apple. A lot of people on the street like Apple, but they think that perhaps near term it's a little expensive. You disagree with that? Yeah,
look, I think Apple is cheap. I don't know how you could call Apple expensive with a PE ratio kind of sub 15 compared, it's actually below the market. And, when we look at the company, it's dominant. You walk through an airport or a mall, everybody's got an iPhone or an iPad. They're looking at an Apple screen. They dominate their segment. They made more money last quarter, in one quarter, than the bottom 400 companies in the S&P in the last 5 years. They're just a dominant company. So we agree with Carl Icahn that this company is worth more than $200.
And your third choice is one whose stock has had good days and not so good days lately, kind of a little more flattish certainly than Apple, and that would be Google.
Yep. So, I think Google's an example of a coiled spring. Again, a company that just dominates what they do, and they've got a lot of embedded options, shall we say, inside the company that we think will be realized in the coming years. So we think technology broadly is the place you want to invest. We think it's more defensive in a time where they may or may not raise rates. And if they do, we think technology is defensive.
Quickly, Mark, why has Google not felt the love?
Well, they ran very hard, kind of the previous 6-12 months. And I think, stocks are cyclical and they kind of go in fits and starts. And it needed a pause that refreshed, and now it's ready to run again.
All right, Mark, thanks very much. Have a great weekend.
All right, you too.
Mark
Thanks
Yusko,
for having me.
Morgan Creek Capital Management.